You're sitting at your kitchen table on the Sunday afternoon, scrolling through Zillow even though you told yourself you wouldn't. There's a house in your area. 3 bedrooms, needs some work, but it's got a yard. The listing price is $425,000. You run the mortgage calculator. With 10% down and current rates sitting around 6.8%, your monthly payment would be about $3,100. That doesn't include property taxes, insurance, or the new roof the inspection would probably flag. You close the app, go back to paying your $2,200 rent, and even though everyone's been telling you for years that renting is throwing money away, something about that mortgage payment feels heavy. Not exciting, not like building equity, just heavy. If that feeling sounds familiar, you're not imagining it, and you're not alone. Over the past 18 months, something fundamental has shifted in the American housing market. It's not just that prices are high. We've seen high prices before. It's that the entire structure of home ownership risk has changed in ways that don't show up in the listing price. And for a lot of people, especially younger families or dual-income households, buying a home right now doesn't feel like stepping into stability. It feels like stepping onto a tightrope. I want to walk through why that is. Not to tell you whether you should buy or rent, that's your call, but to help you see the trade-offs more clearly. Because this isn't about being smart or dumb with money. It's about understanding what you're actually signing up for when you go from tenant to owner in 2026. Let's start with the numbers everyone talks about, and then get into the ones they don't. The mortgage rate problem. For about a decade, from roughly 2010 to 2021, mortgage rates in the U.S. hovered between 3 and 4%. That was historically unusual. It meant that even as home prices climbed, the cost of borrowing stayed relatively cheap. A $350,000 mortgage at 3.5% had a monthly principal and interest payment of about $1,571, manageable for a household making $85,000 a year. Today, that same $350,000 mortgage at 6.8% costs $2,283 per month. That's a 45% increase in your monthly payment for the exact same loan amount. And that's before property taxes, homeowners insurance, HOA fees, or maintenance. Now, according to the Federal Reserve, the median home price in the U.S. as of late 2025 was around $417,000. Let's say you're buying at that price with a 10% down payment, so you're financing about $375,000. At 6.8%, your base mortgage payment is roughly $2,450 a month. Add property taxes, the average effective property tax rate in the U.S. is about 1.1% annually, according to the Tax Foundation. On a $417,000 home, that's about $380 per month. Homeowners insurance averages around $150 to $250 per month, depending on your state. Let's call it $200. So now you're at $3,030 per month before you've repaired a single thing. For a household bringing home $7,000 after taxes, that's 43% of take-home income, right at the edge of what lenders consider acceptable and well above what most financial advisors recommend for long-term comfort. But here's where it gets more complicated. That percentage assumes nothing goes wrong. When you rent, your dishwasher breaks. You call the landlord. When you own, your dishwasher breaks. You're out $800. Your HVAC system fails in July? That's $6,000. Roof needs replacing after 15 years? $12,000 to $20,000 depending on your market. The general rule of thumb, cited by organizations like the National Association of Realtors, is to budget 1 to 2% of your home's value annually for maintenance and repairs. On a $417,000 home, that's $4,170 to $8,340 per year, or $350 to $695 per month. Suddenly, your $3,030 monthly obligation is really closer to $3,400 to $3,700 when you average it out. And that's still assuming you don't have an HOA, a septic system, or a crawl space that starts flooding. Now compare that to renting. Let's say you're paying $2,200 a month for a similar home. No maintenance costs, no property tax, no insurance beyond renter's insurance, which runs maybe $20 a month. When something breaks, it's not your problem. You're saving $1,200 to $1,500 per month in real cash flow. That's $14,400 to $18,000 per year you could put toward retirement, an emergency fund, or just breathing room. But the bigger issue, one that doesn't show up on any mortgage calculator, is flexibility. When you own a home, your largest monthly expense is locked in. You can't just downsize your housing payment if you lose your job or want to take a sabbatical or move for a better opportunity. Selling a home takes months. It costs 6 to 10% in transaction fees, and if the market's down, you might lose money or get stuck. Renting, by comparison, is movable. Lease ends, you move. You take a job in another city, you don't have to worry about whether your house will sell or whether you're underwater on your mortgage. This is especially important for dual-income households. If both partners are working to afford the mortgage, that mortgage isn't just a housing cost, it's a lifestyle lock. You can't afford for one person to scale back, shift careers, or stay home with a new baby. The house requires both incomes, which means both people are required to keep working even if circumstances change. And here's the thing, circumstances always change. According to the Bureau of Labor Statistics, the median job tenure in the U.S. is only about 4 years. People switch jobs, get laid off, burn out, have health issues. The idea that both partners will remain stably employed at current income levels for the next 30 years is optimistic. Now, people will say, but you get the mortgage interest deduction. That's true, but it's not as valuable as it used to be. After the 2017 tax reform, the standard deduction for married couples filing jointly is $29,200 as of 2026. For most middle-class homeowners, the combination of mortgage interest and property taxes doesn't exceed that threshold, which means you're not actually getting a tax benefit from owning. You're just taking the standard deduction like everyone else. And even if you do itemize, the mortgage interest deduction only reduces your taxable income. It doesn't give you cash back. If you're in the 22% tax bracket and you deduct $15,000 in mortgage interest, you save about $3,300 in taxes. That's helpful, but it's not changing the fundamental math. Meanwhile, renters who aren't house poor can max out retirement accounts, which also reduces taxable income and grows tax deferred. A couple contributing $13,000 each to their 401ks is reducing taxable income by $26,000 and actually building wealth that's liquid and portable. So here's where I want to shift how we think about this. We've been taught that homeownership is wealth building and renting is wealth wasting. But that framing assumes homeownership is always the optimal financial vehicle, regardless of price, rate environment, or personal situation. And that's just not true. Homeownership builds wealth when you buy at a reasonable price relative to local incomes, you hold the property long enough to overcome transaction costs, appreciation outpaces inflation, and you can afford the payment comfortably without sacrificing retirement savings or liquidity. But when mortgage rates are high, prices are elevated, and your payment eats up 40+% of your income, you're not building wealth, you're building risk. Renting, by contrast, is not throwing money away. It's paying for housing and flexibility. And in an economy where job security is low, childcare costs are high, and healthcare is tied to employment, flexibility is worth something, maybe worth a lot. If you're trying to decide whether to buy or rent right now, here's a calm, practical way to think through it. First, stability. Can you afford the mortgage, taxes, insurance, and maintenance on one income if something happens to the other? If the answer is no, you don't have stability, you have dependence, and dependence is the opposite of security. Second, flexibility. Do you know where you'll be in 5 years? Is your career path clear? Are both partners locked into their current jobs, or is there a chance one of you might want to shift, scale back, or relocate? If flexibility matters, renting preserves it. Owning restricts it. Third, growth. If you can afford the home comfortably and you plan to stay put for 7 to 10 years, then yes, homeownership can be a wealth-building tool, but it's the third priority, not the first. Stability and flexibility come before growth, always. Let's take a real example. A couple in their early 30s, combined income of $110,000. They're renting for $2,200 a month. They've saved $50,000 for a down payment. If they buy a $425,000 home with that down payment, their mortgage at 6.8% is about $2,450. Add taxes and insurance, they're at $3,100 a month, plus $400 for maintenance reserves. Total, $3,500. After taxes, they're bringing home about $7,200 per month. That mortgage takes up 49% of their income. They can do it, but it's tight. If one of them loses their job or wants to go part-time after having a kid, the math breaks. Alternative path, they stay renting at $2,200. They invest the $50,000 down payment in a diversified index fund. They save the $1,300 monthly difference between renting and owning. Over 7 years, assuming a conservative 7% return, they'd have about $230,000 in liquid, portable wealth. That's not throwing money away, that's building optionality. Look, I'm not saying don't buy a house. I'm saying don't buy just because you think you're supposed to. Don't buy because renting feels like failure or because your parents keep asking when you're going to settle down. Buy when the numbers work, when you can afford it on one income, when you know you're staying put, when the mortgage doesn't eliminate your ability to save, invest, or pivot if life changes. Because here's the truth. Security doesn't come from owning a home, it comes from having options. And right now, in this rate environment with these prices, renting might actually give you more options than owning. That's not a failure, that's clarity. If this helped you think through your situation a little more clearly, I'd appreciate it if you'd hit the like button. Subscribe if you want more financial breakdowns like this, and drop a comment if you're wrestling with this decision. I'd love to hear where you're at and what you're thinking through. Thanks for watching, I'll see you in the next one.